Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
There's really some key requirements for success of the euro, and it really doesn't meet any of these, unfortunately. But we're told that it's been meeting all of these. The first requirement, really, in terms of they refer to this. The economists refer to this as a common currency zone, and have a more general definition. I tried to give a more specific definition so you can put your arms around the reasons why we think the euro is really inherently flawed from the get-go. Number one, in terms of a common currency zone, you want to have the individual states that have synchronized business cycles. They really haven't. A bit, again, in this cycle, we've seen some of that because of this liquidity-driven boom. But in general, the states that make up the euro really are not synchronized. They need to be synchronized because you really have a one-size-fits-all monetary policy. The European Central Bank sets one interest rate for the entire Eurozone and those that are part of the monetary union. Now, if, for example, your country is going into recession, yet the European Central Bank sees fit to raise interest rates because Germany, the core, which is what the monetary policy is really designed around for Germany, and as I said, your country is going into recession, your country does not want to see higher interest rates, but that's happened, and it will continue to happen in a one-size-fits-all monetary policy when the business cycles aren't synchronized. You may remember George Soros made the $2 billion in one day when he broke the Bank of England. At the time it was 1992, and the European monetary system was still in creation then and really genning up. Britain decided that Maggie Thatcher decided she wanted the UK into the monetary system. And I tell this story to make the point of synchronized business cycles. So Maggie Thatcher, being bold, pegged. Remember the D-mark is the anchor currency, which all the currencies pegged around to get into the system. They pegged against the D-mark. So Maggie Thatcher pegged the UK or the British pound against Germany at a very high rate. And it just so happens in 1992, Germany was in the process of taking over East Germany. So what did Germany need? Germany needed higher interest rates in order to attract capital for its takeover of East Germany. So the Europeans, so the Bundesbank at the time hiked up interest rates. That was exactly the wrong policy for the UK, which was about to go into a very nasty recession. Soros looked at it and said, there's no way the UK is going to stay in this system. There's a political death if they accept higher interest rates in this system. And sure enough, he bet against them coming out of the system. They did. And again, the problem was synchronized business cycles. They weren't synchronized, and that's why the UK dropped out of the system, and the British pound has never re-entered the monetary system, even though they're a member of the Eurozone. So this is a big factor here. And it hasn't been in this cycle because it's been such a liquidity-driven straight up for everybody. But that will change in a world in which liquidity isn't the only driver, and we don't have the same type of credit cycle. So this will come back to the fore, this inherent change in business cycles being a real problem for a one-size-fits-all monetary policy. The other key requirement is political unity, which, again, the states of the United States tend to have. There's no political unity really in Europe per se. You have competing cultures. You have different regulations and laws across the books on all the individual countries. And this creates a real problem, not only from just a squabbling standpoint behind the scenes and the idea of there's still a demand for sovereignty from all these different political units out there. They've never come together on this. And the problem it creates in terms of laws is the fact that European Central Bank really lacks cross-border mechanisms in order to deal with the current crisis, because there's a lot of different laws in the books in all the different countries from a banking regulatory standpoint. The European Central Bank is handcuffed in dealing with this crisis. They also have no treasury as part of the European Central Bank. It's a bank without a treasury, and it has to buy, and it goes to the point, if it's going to subsidize the system, whose bonds does it buy? Does it buy Italy's bonds, Spain's bonds, German bonds? How does it dole out the money? So there's all kinds of inherent problems in their ability to deal with a cross-border crisis like this. Fiscal equivalency. Part of this stability, it was called the Stability and Growth Pact, is what kind of was the key behind the rules behind the monetary union. And within that, there's certain disciplines that each of the countries have to maintain. Disciplines primarily of federal deficits as a percentage of GDP. But we know there is really no fiscal equivalency, because how could you ever compare Germany and their conservatism and their very solid fiscal policy to somebody like Italy or Portugal? It just, from the get-go, again, it was ridiculous. And at the moment, now that all the individual countries are screaming for liquidity, they're breaking these treaty, I guess, commitments, you can say, in a very, very big way, and well beyond, in terms of percentage deficits to GDP, well beyond what initially they signed up to be even part of the union. So from a legal standpoint, based on treaty, these countries should have been thrown out of the union a while back. And I'm talking about Greece and Italy, and Spain is starting to blow out in a big way, and I'll show you Spain. These countries, these southern tier countries that have the liquidity, the fiscal problems, are referred to as the PIGS. You may have heard this, not a very nice term, but it's the acronym for Portugal, Italy, Greece, and Spain, the PIGS. And basically you have a country like Germany, which subsidizes the PIGS. Because there is no fiscal equivalency in the European monetary system, it should mean that the interest rates that are charged for Greece or Italy to borrow should be 500, 600 basis points above what Germany should borrow at. But that was part of the reason and I'll get to that in the next slide, was created. There's no way that Italy should have been able to borrow at the same rates that Germany did, and that went on for many, many years during the upswing. We're finally starting to see those spreads widen, and I'll get to that. But without this fiscal equivalency, it just doesn't make sense. And this is one of the things Trichet is very much concerned about, because he knows it's almost every man for themselves here, rats jumping off a sinking ship. And a lot of the countries are very nervous and demanding liquidity, and they don't want to stay under the straitjacket of the treaty. Again, it goes back to the point at which Soros saw developing in the UK. It's politically unviable now for these countries that are just screaming for liquidity. We've seen riots in Greece and a lot of tension across the entire Eurozone because of the fact that they have to maintain some austerity. But that could break wide open very, very soon.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.